operators based in the Middle East and North African region are increasingly reliant on the Qard Hasan. I'm Yvette Essen for AM Best TV, and I'm joined by Salman Siddiqui, Associate Director of Analytics for AM Best, to talk about this reliance on the interest-free loan and what companies can do to stop that practice. Can you explain to me, first of all, what exactly is the Qard Hasan?
So the Qard Hasan is a benevolent loan. Effectively, it's an interest-free loan that's advanced from the shareholder account to the policyholder account to cover any policyholder deficits. Now, these deficits can arise for a number of reasons. They can be poor underwriting controls, poor risk selection, poor pricing. There can also be excessive wakala fees. Companies are very reliant on this because of the fact that policyholder funds continue to make losses or deficits year after year. AM Best analysis has shown that over the past 10 years, on an aggregate basis, Takaful companies in the Middle East and North African region have generated policyholder deficits year on year, and therefore the accumulated deficit has increased year on year, and therefore the need for Qard Hasan has actually increased year after year across the MENA region.
Well, thanks for explaining that and giving me the definition. While we're talking about definitions, can you explain about the wakala fee as well? What exactly is that?
So the wakala fee is basically how the shareholder is remunerated for its services to the policyholder fund. So the shareholder incurs expenses to operate the policyholder fund, and it requires compensation for that. And that's the wakala fee that's charged to the policyholder fund and is taken to the shareholder fund.
Now, AM Best has a specific Takaful methodology, and we take into account the uses of these different types of loans. How is it exactly accounted for, the use of the card in practice?
So AM Best does have a Takaful specific methodology, and as part of the methodology, we're required to look at the capital adequacy of the policyholder fund on a risk-adjusted basis. Now, if there's no surplus in the policyholder fund, then clearly there's no capital adequacy. However, in regions where the regulations is strong enough and there's Takaful specific regulation that mandates a Qard Hasan, or the company's articles of association require a Qard Hasan, then we can consider the shareholder's capital to be fungible for the use of policyholder risks. And therefore we can do a combined assessment on the company utilizing the consolidated accounts for risk-adjusted purposes. Now, the Qard Hasan from that point of view is actually credit positive for the balance sheet strength assessment of Takaful companies. However, over-reliance on the Qard Hasan can lead to an imbalance of earnings. Now, the methodology also requires us to look at the balance of earnings between the shareholder account and the policyholder account, and this over-reliance will mean that there's an imbalance between the two funds, which will be a negative to the operating performance assessment of these Takaful operators.
AM Best has published a lot of reports this year, including a briefing recently on the use of the card. Now, that briefing says this reliance is a perpetual card syndrome. Why is this a bad thing?
So continued reliance on the Qard Hasan we consider to be credit negative. The whole point of the Qard Hasan would be that it mitigates the conflict of interest that's inherent between the policyholder fund and the shareholder fund. Do bear in mind the wakala fee, as I mentioned, is tied to the top line or to gross written contributions of the policyholder fund. And this creates a conflict of interest because the operator is incentivized to target top line growth over bottom line profitability. Now, what that means is that can lead to continued policyholder deficits. The Qard Hasan should mitigate that in that sense. However, when you continue to rely on it year after year, it removes this mitigating factor, and basically the conflict of interest re-emerges for these Takaful operators.
So there's a number of reasons why this shouldn't be continued, but what can companies actually do to stop their reliance on it?
There's a number of things they can do, but I think there's two key areas that we can look at. The first one is the wakala fee itself. Now, as I mentioned, it's tied to the top line, and that creates a conflict of interest. If we can break that tie between the two, that will help reduce the conflict of interest. For example, we can look at the expenses that the shareholder expects to be borne over the next year or so, budget them appropriately, and then add in a margin for the cost of equity, which you can utilize a CAPM model to get the accurate answer. And then you can fix the absolute amount of the wakala fee for the entire year. That's one way of doing it. The other way to do it is to remunerate the shareholder using a profit sharing mechanism. So if the policyholder fund makes a profit, some of that is shared with the shareholder. This is something that Malaysian companies have done over the years, and they've been quite successful at it. The other option we can look at is the Saudi cooperative model. Now, the Saudi cooperative model is Sharia compliant, And it doesn't have a significant level of conflict of interest because 100% of all losses are borne by the shareholder and 10% of all policyholder profits are shared with the policyholder. So that conflict of interest is somewhat mitigated.
A copy of AM Best reports and briefings on the Takaful sector, including the AM Best Takaful methodology and AM Best briefing on the Qard Hasan, can be found on the website ambest.com. For AM Best TV, I'm Yvette Essen.